So people who are, disenfranchised, people who feel excluded, all those kind of non-financial payoffs. There's, it isn't just that they're in it to make money. It's all the kind of political, it's revenge for the crash of 2008 as well. It's kind of, sticking it to the hedge funds. But those kinds of motivations, we can trace that back and seeing, other outlets, other brokerages that have sold the same kind of idea. So it's a message of populism, which probably isn't going to go away.
And you've seen that repeat throughout history at key times.
Yeah, it's kind of really the origins of that one, not necessarily 300 years, but late 19th century with these outside brokerages, bucket shops. The language of that is very overtly populist and kind of very down on the stock exchange inside elites. And it's particularly strong in America, where their politics are developing in interesting ways with growing concerns about the power of elites. And so these brokerages were really pushing this democratic populist kind of language that tied in with the politics of the time. We're standing up for the small man, the small guy.
Like say 2008 might have been similar. People really turned on financial markets. People thought, you're the reason that we're like this. You've ruined everything basically. How does the literature navigate those periods?
Well, yeah, you would think with huge difficulty, but it's weird how they just kind of skate along the surface of it. You can highlight a few, overt cases where so-called experts, are making big statements in the autumn of 29, just before the crash, saying, things are going to go up now is a great time to invest, like literally weeks before the crash. So it's kind of harder for people who've really stuck their neck out. But in the broader kind of genre of financial stock market advice flourishes through those years. Admittedly, there's a smaller market. A lot of people have lost a lot of money. So the stock market does shrink. It doesn't regain its post pre-1929 levels until the 1950s. But the genre keeps going, and that's when you get the real flourishing of fundamental analysis.
Is it that because their style failed us? They were wrong, we've got the answer now. Is it that?
It's kind of, a lot of it is, it's slightly more difficult for the technical analysts, the chartists, to kind of get the way out of it, although they do. But in post-29 regulatory climate, where you get more and more data becoming available because of disclosure requirements being placed on corporations for the first time, much more extensive. So much more data, and that really feeds into the growing trend of fundamental analysis, value investing, because you can crunch the numbers yourself now. All this data, which was private, is now publicly available. So that really provides a big boom to fundamental analysis, and the idea that, well, we didn't have all these skills and all this knowledge before 29, but now we do. So, again, this time it's different. We can approach investment in a much more scientific way. We won't get burned like people did in 29. It's a very
convincing message, isn't it? It's like, we've got the science now, they didn't before.
Exactly, yeah. So there's always an angle, there's always a way, despite, 1929 was huge. Like the market loses, was it 89% of its value between 1929 and 32? It's huge losses.
That's a dip. I lost that last year in crypto. It was about 80% did drop. Yeah, but that's crazy. Man, you've got like so much money in there, and it's just.
Oh yeah.
And it's over how many years? Two or 3 years?
It's about 3 years. Yeah.
So was it on average per year like 25%, or how did it?
Absolutely tanked.
It just tanked. No.
There was some like traps in there as well. I think it rose, like dead cat bounces as they call them, and like people threw their money back in. And there was, even when it was dying, people were like, it's going to come back. And people caught falling knives and all those sorts of terms.
It's just, people got into, like 1930 saying, well, that was bad, but now's the time to buy it. And then they're the ones who lost
another step down. Yeah. Have you, throughout your 300 years of research, have you ever seen anyone that's got the answer? Where you're like, this guy probably had it nailed. Like,
it's a good question. It's tempting to say yes, but I mean, a lot of people have got a bit of the answer, but in kind of like trying to find the perfect solution, like the Holy Grail, it's probably a myth. It's probably, that we're never going to find the surefire route to riches, but it's the quest for that. The quest for someone who figures it all out is kind of, that's what keeps, people investing, keeps people reading, whether it's the manuals, which still exist, they're still flourishing as a, genre. The internet hasn't killed them, but obviously the internet has increased the number of platforms. So it's still going. But if there is a Holy Grail, then it's kind of, passive investment. That's the closest we've come to kind of, figuring out, well, we can't beat the market, but maybe we don't have to.
That was a clip from James Taylor. This guy read 300 years of finance history, so you don't have to. Check out the full episode right here.